Welcome ladies and gentlemen to this video. Alphabet is one of the most dominant companies with probably the most durable competitive advantage or moat that would be next to impossible for the competitors to breach. With the Google search engine, the second most popular search engine and video sharing site YouTube, the world's most prevalent mobile operating system Android, and the Play Store, the growth is simply unstoppable. The multiple income streams from all of these, as well as Google's interconnected ecosystem of software solutions, gives it an enviable competitive position. Google's strong Q4 results. Google parent Alphabet reported better than expected fourth quarter earnings and revenue. Here are the key numbers. Earnings per share $30.69 versus $27.34 expected. Revenue $75.33 billion versus $72.17 billion expected. YouTube advertising revenue $8.63 billion versus $8.87 billion expected. Google Cloud revenue $5.44 billion versus $5.47 billion expected. Traffic acquisition costs TAC $13.43 billion versus $12.84 billion expected. Google's unmatched consistency, and it is the only stock that I ever came across in my investment journey which gets a feasibility score of over 85% over the time frames of 10, 5 and 3 years respectively, as per my custom investing dashboard. And that is astonishing since I did not see any other firm with such a rock solid consistency, and that is unmatched in the tech sector. It shows that the ship of Google has been traveling perfectly in the right direction since the past decade and has been successful in overcoming every competitive pressure, radical innovations and macroeconomic events. And this is due to occupying and retaining the topmost position in the search space, the mobile ecosystem space, online advertising and video sharing platform space. Google revenue growth and durable competitive advantage. Alphabet reported revenue growth of 32%, proving again that it was able to withstand the pressures from the pandemic and inflation. The results follow a year of outperformance. The stock surged 65% last year, beating all of the big tech companies and giving its investors more than 3 times the gains as in the case of S&P 500. Google's advertising revenue came in at $61.24 billion for the quarter, which is up 33% from $46.2 billion in the same period last year. Philip Schindler, Google's chief business officer, said retail was the largest contributor to year-over-year ad growth. Media and finance spending was also significant. As the earnings of Alphabet Inc. outperformed expectations in Q4, many tech giants like Meta Platforms and Netflix crashed and could not provide satisfactory results. And as we can see, the Google stock shows a steady growth over the years which is organic. It is not something based on news or hype and totally based on the network effect and its underlying outstanding fundamentals. Although Google trades at a significant premium to beaten down tech names like Meta Platforms and Alibaba, the premium is largely justified. Google is one of the few tech companies that not only owns websites and apps but also the platforms on which they run. It is the owner of the Android operating system, the world's most popular mobile operating system by installs and the second most valuable by app revenue. And now Google is also very active in designing hardware. Even though Google Pixel phone has made giant leaps recently with the release of the Tensor chip to provide an unmatched end user experience, it will take some time to beat the perception of Apple's iPhone. But in a few years, I believe this is destined to happen. With the release of their own chip, the Android operating system will undergo refinements to make the end user experience on par and even exceed iPhone. The recent reviews of the latest Pixel phones tell the unbiased story. And this initiative of Google will also pave the way for Google to tap into the laptop markets to compete head-on with Apple MacBooks. Furthermore, unlike Apple, device manufacturers like Samsung, LG and others will keep on providing their own custom look and feel that will keep on enhancing the end user base of Google services and the install base of Android Play Store apps. So with time, Apple will see its market share shrinking on all fronts. And don't take my word for it. In the recent Daily Journal investors meeting, Charlie Munger mentioned Google and Apple as the two notably entrenched tech companies. By that he means that their position in the market was inaccessible. Other tech companies could only dream of such a strong placement in the business environment. Additionally, its largest ad platform Google.com does not depend on data tracking anywhere near as much as social media platforms like Facebook do, which provides an additional layer of safety. For these reasons, Alphabet can be thought of as a fortress company, deeply entrenched in the online advertising industry with almost non-existing competitive threats. Competitive landscape. If a company has a dominant position in a growing market, it is reasonable to think that its earnings will grow over time. So let's take a look at how Alphabet's stock stacks up against the competition. In online advertising, Google's main competitor is Meta Platforms. It has a 24% share of the market, second only to Alphabet itself. The third on the list is Amazon with an 11.6% market share. Other noteworthy players are Microsoft through its LinkedIn subsidiary and smaller social media players like Snapchat and Twitter. Alphabet's own share of the online advertising market is 28%, by far the largest of any company, even though it is not necessarily an advantage, but I believe that in Alphabet's case, there are reasons which will help it in maintaining this position. The first of these is platform control. Alphabet owns not only websites and apps, but also the browser Chrome and operating system Android. This means that Alphabet's business is less vulnerable to the actions of other companies as compared to the competition in the advertising space. For example, let's look at Meta. In 2021, Apple on its own removed a chunk out of Meta Platforms' revenue by hampering its data tracking. In early 2021, Meta admitted that this move of Apple will cost it $10 billion by year's end. Also, Meta cited TikTok, supply chains, and other factors as headwinds for its business. Alphabet is far less vulnerable to these risk factors. Alphabet controls its own mobile operating system, making it less vulnerable to the moves of other companies such as Apple. In other words, Apple has taken a sizable chunk of revenue away from Facebook by blocking tracking, but Apple won't be able to do that easily to Alphabet, which has its own mobile platform on which it sets policies itself. So even though Google apps were affected by Apple's app tracking transparency or ATT changes, just like Facebook's were, but Alphabet decides the policies on Android platform itself, which is a huge advantage. So even if Alphabet does bring in app tracking transparency ATT for Android, it can give itself preferential treatment like Apple did when it introduced the tracking changes on iOS platform. Google's second big advantage is that its advertising platform doesn't depend on data tracking as much as some companies do. On Google search, Alphabet can simply show ads relevant to what the users search for. This doesn't require any prior knowledge of the user to be effective. To be sure, Google does use retargeting and location data to make campaigns more effective, but Google core ad functionality doesn't need a huge amount of data to show a relevant ad. If you search for notebooks, Google can use just that one piece of information to show you the ads for notebooks. There is no comparable way to instantly target on social media apps, which have fewer information-based queries and more personal ones. Rock solid financial. So the current price of Google stock is $2,613 US. The market cap is over $2 trillion US. The PE ratio over the trailing 12 months is 23.2. Earnings per share are $112.2 US. The current price to book ratio is 7. The current price to sales ratio is 6.8, while the current price to free cash flow ratio is 28.8. Over the past 5 years, the average yearly revenue growth has been over 20%. The average asset growth has been 17%. The average equity growth has been 13%. The average net income growth has been 31%, while the average liability growth has been 30%. The total revenue grew from $29 billion to an astonishing $183 billion US, while the net income grew from $9 billion to $40 billion. The growth in free cash flow has been amazing, and it increased from $7 billion to $43 billion. And as we can see, Google can pay its long-term liabilities with a free cash flow from around past 7 years, which is great for a company of this size. The average ROE and ROIC has always stayed above 15% over the time frames of past 3, 5 and 10 years, which is a superb consistency, and the diluted shares outstanding have declined over the past 10 years with an average decline of 1.39% per year, which is good for shareholders since it means that they increase their ownership in Google by owning the same number of stocks. Also, their current assets are greater than current liabilities, which is another positive indicator of its financial strength. And Google stock is probably the only stock that I came across which gets a feasibility score of 86% over the time frames of past 3, 5 5 and 10 years. Therefore, I believe that Google is a good long-term investment and will give the investors a solid return over the coming years. Its moat or competitive advantage give it the immunity and resilience to generate consistent cash flow. I hope that you like the content of this video. Let me know in the comments below, what do you think about the Google stock? Do you think that it is a solid long-term investment? Would you like me to make such videos in the future? If you found this video useful, please don't forget to smash the like button for the YouTube algorithm and consider subscribing. That would mean world to me. Thank you so much for watching. I really appreciate it. You all are awesome, and I will see you guys in the next video.